Hello and welcome back. Today we're going to do a property feasibility calculator for a client that wants to either buy a property as a rental income property versus an investment. Now, earlier I did a calculator or a video based on this calculator of this same client scenario where the client will either live in the property, in other words, buy the property to live in it, or buy an investment or do an investment and then pay rent to live in that property. It's the same seller that is trying to sell the property that is offering this property to rent, and it's kind of a market related rent to the property value. It's a 2.8 million property value and a 20,000 Rand a month rental offer. So in this calculator, we're going to focus on buying this property as an investment choice. In other words, as buying it as a rental property. And then this person will not live in that property and have to find alternative accommodation. Right, so in this case, the property value is 2.8 million. The transfer bond and attorney's fees is 153,000 Rand. Now, there's no bond registered against this property, but the transfer fees and transfer duties and attorney's fees is 153,000 Rand. If there was a bond registered against this property, the total cost would come to around 203,000 Rand or 205,000 Rand, more or less. And the reason why we have this section, net value after initial cost, 2.6 million, this reduced rate, is because this 153,000 Rand is a sunken cost. It's value that's lost. It's money that is paid towards the attorneys and towards government taxes for the property purchase. And we can't use that money for any other reason. In other words, we can't invest it or keep it on the side and make it grow. So we have to, in some way, make a sacrifice with it. So we deduct it from the initial property value. Right, there's no loan amount. There's no interest rate that applies because there's no loan amount. There's no amortization period of 20 years in this case. So we're not doing that. There's no begin date of the loan, but this part is applicable. So there's a rental income on this property of 20,000 Rand. So we're going to assume a 20,000 Rand rental income on this, which is very much market related for this property. In other words, this actual client also got offered from the seller that this client can buy the property for 2.8 million, or the client can rent the property for 20,000 Rand a month until the client is ready. The rates and taxes and levy and insurance for this property is 4,500 Rand, and this is given by the client. In other words, the rates and taxes is 2,500 Rand. If you look in this blue block, the levies 1,600 Rand and the insurance 400 Rand, and combined it's 4,500 Rand. So if you can just look back at the rent and the costs, if the client should rent this out, they'll get 20,000 Rand, and the cost of 4,500 Rand will have to be paid. So that it's not a clean profit of 20,000 Rand. Right, let's look at the assumptions. These assumptions are well researched. In other words, this is assumptions that's currently in the market. Property growth rate per annum, 3.2%. And that's according to Lightstone, the Lightstone report. Lightstone is a company that provides property statistics or property growth rates in South Africa. And that's a national average. In some provinces and in some suburbs, specifically in certain provinces, you might get a higher rate. In some provinces or some suburbs, you might get a lower rate, and also depending on the property size that you buy. But this is quite accurate reflection of the current property market. The rental increase per annum is 4.2%. In other words, this client will get 4.2% per annum. And that is also based on market research of rental income countrywide. The rental increases per annum countrywide is slightly lower, or actually much lower than the actual inflation rate of 6.8% currently. Levies, rates and taxes and insurance, we can assume a 6% per annum increase. I've got a 3 asterisk, triple asterisk there as a cautionary note. And that's for rates and taxes, for example. The municipal failure and maladministration in South Africa has caused a lot of municipalities to not deliver services as promised. And for that reason, I think that rates and taxes might go up more than inflation over the next couple of years, but we're going to stick with the 6% here. Same with levies. Levies are the fees you pay if your property's in an estate, and a lot of estate properties have to pay more on levies to secure the property. In other words, they pay more on security costs to keep people safe inside, and sometimes even pay extra fees to do certain services inside the estate that the municipality can't run as efficiently as they should. But we will stick with 6% there. Right. Okay, so let's see how the calculator works down here. It's a very detailed calculator. On the left-hand side, you can see every month is represented by a line or a row, and then every 12 months or every year is represented by a gray line. So let's look at year one. You can see 20,000 Rand rent per month. After year one, you've accumulated 240,000 Rand rent. You've paid 4,500 Rand in costs, so 54,000 Rand in costs. Your monthly cash flow is 15.5 positive. A minus equals a negative, so this is positive cash flow. So you've made 186,000 Rand in year one, and that the property value after year one will be 2.7 million. Remember, we work on this lower amount here because you couldn't, otherwise you would have, just to point that out again, this 153,000 Rand gets deducted from the 2.8 million property value because you could have invested that money in somewhere else. All right. So what are you worth, let's say, after a full year? 2.9 million. Now, the reason for that is it's the property sale price plus the cash flow positive value that you've accumulated over time. Okay, the 186,000 Rand, that's a rent minus levies or rent minus costs. All right, so after 5 years, you'll have about 4 million in your pocket. After 10 years, you'll have 5.8 million in your pocket. Let me just show you what it looks like on this chart. 120 months is 10 years. So then you'll receive about 28,000 Rand a month rent. You'll have received 2.9 million Rand in rent over time, 7,600 Rand costs, and 700,000 Rand accumulated cost. Your cash flow positive, you are cash flow positive 21,000 Rand a month at this stage. Your property sale price is 3.6 million at this stage. And all in all together, you're going to have 5.8 million in your pocket, right? That's how that works. After 20 years, you can see the same thing here. You're getting 43,000 Rand rent a month, etc., etc. So you've got 10.2 million in your pocket. Right, so let's compare this to a investment of the same value. Right, so in this case, we're going to use an investment of 2,953. So this is the 2.8 million plus the 153,000 Rand upfront fees that you would have paid on the property, because we have to do it that way because you have that cash in hand, and that cash of 2,953 is what you will either use to do the investment or to buy the property plus pay the upfront fees. Expected growth rate of 10%. That's quite moderate for a long-term investment. This is a endowment, and we're going to assume you invest aggressively. We will also calculate taxes and all of these things down here. In other words, so we're going to make it quite realistic where your investment is calculated after tax. Okay. Right, let's look at this. So on the left-hand side, in this block here, you can see the accumulated growth, and here's your balance. Right, so after 5 years, your balance will be 4.7 million. After 10 years, it will be 7.6 million. And after 20 years, it'll be 19.8 million. On this right-hand side here, I've got a calculation that calculates the tax on the investment. I'm just going to remove the rest of it because that calculation has a lot of things to the right, which is not applicable to this. So personal endowment after tax, here you can see the tax applicable to the investment. And in the previous calculation that I did, we did calculate if you had to pay rent. But in this case, remember, the client purchased the property and the client is getting a rental income from it. Okay, so after 10 years, the client will have 7 million in the bag, and that's after tax. Let's see, after 10 years, 5.8 million in the bag. That's for the property. 5.8 million versus 7 million. After 20 years, 17.8 million. And after 20 years, here, 10.2 million. Right. So clearly the investment has a better outcome compared to the property. Now let's do the following. Let's assume you're more positive on the property investment, or you're more optimistic. Let's assume you get a 4.2% growth rate and you get a rental increase of, let's make it 5.2. Okay. So then after 10 years, you'll have 6.3 million cash in hand. Just to reiterate that after 10 years, 6.3 million cash in hand if you sell the property. Just remember that. Right, after 10 years, you'll have 7 million in your hand. In other words, after tax. After 20 years, you'll have 17.8 million. In this case, after 20 years, you'll have 12.1 million. Okay, so the investment in this example still outperforms the property. Let's see where the property becomes better. Let's say if you do 5%, the property grows at 5%, you'll have 13 million versus the investments 17 million. If the property grows at 6%, it's quite an optimistic amount there, then you will have 14.5 million in your pocket versus 17 million. Now, this 17 million already calculates taxes on the investment if you withdraw it. Something you have to consider when you have a rental property is that you're not going to get the 2 million capital gains tax allowance on the gain of the property price. So you're going to pay tax on the gain. Let's look at that example here. So it's not going to be this 14 million at 20 years because that's including all the rental income that you've accumulated over time. We're going to go to the 20-year figure here on this line called property value at growth rate, which is 8448165. I'm going to do a quick calculation inside the Excel here. 8448165. So we're going to see how much the gain is. It's going to be that minus the purchase price. If you did any improvements over time to the property, in other words, you invested in building a separate room or anything like that, that can also be deducted from this. Just consider that one has to then equate to adding money into an investment as well. If you have to equate if it's a good investment. Remember this calculation is purely for the purpose to determine if it's a good investment, not for, how comfortable it is or your lifestyle or anything like that. Right, so that's what the gain is going to be, 5.6 million. And what's going to happen, it's got the tax law works like this. It's a 40% inclusion rate. And then on that inclusion rate, you're going to have your marginal tax rate applied. So marginal tax rate is the highest bracket that you are currently in with your income. And in this case, we will assume a 45% tax bracket because if if you earn more than 1.8 million, round about more than 1.8 million in South Africa, you're in the 45% tax bracket. So this is far above that. So we will do this. We'll say that amount. Look, you have another 40,000 allowance in general. So we can do that. We can say that minus 40,000, 5.6 million. Then the inclusion rate on that will be okay, so 2.2 million, and then that 2.2 million will be taxed at 45%. Okay, so that's another million there. So of the 8.4 million sale price, you'll pay another million worth of tax that comes off this off the total property price, but it will reduce this amount of cash that we will assume you're going to have in your pocket after 20 years of renting out this property with all these assumptions built in here. And compared to the investment, once again, being 17 million, the investment will be about 18 million, 19.8 million, the balance, but you will get 17.8 million out after tax. So the property really has to perform quite well in order to outperform this. So what else can you look out for when you buy a rental property? Just note that it can take some of your time. It can have additional costs like maintenance, because tenants might not treat your property the same way you would treat it. And if there's a really stubborn tenant that doesn't want to get out, you might have to go to court to get them evicted from your property. It's not all doom and gloom. And with this calculation, what I'm trying to say is that just know the value or how much this property is going to cost you over time, how much money you're going to make from it. Because what we sometimes do, we've got a psychological inclination as humans that when we see something and we can feel it, that we think it's more valuable. So property, you can literally show someone, you can see it, you can feel it with your hands. And an investment is just a statement. It's just a piece of paper, or even these days, not even a piece of paper. It's just a bunch of numbers on a screen. But those numbers might mean more than in financial terms than a property. It's not always the case, but I hope I've cleared some of that up here. If you like my video, please don't hesitate to ask me any questions. Please comment in the comment section below. Please like my video, please subscribe, and we'll see each other soon.